But let's shift focus to Piramal Pharma. The company did come out with a good set. The margins held steady. The profit after exceptional tax saw a jump of more than 50%. But what's the way forward? Let's try and find an answer to that. We are being joined by Nandini Piramal, Chairperson of Piramal Pharma. Hi Nandini, a very good afternoon and good to be speaking with you. Nandini, firstly, let me start with the US market. Help us understand what is your growth outlook for the US market, especially in the context of increasing tariffs and the US government's push towards insourcing development and manufacturing. How are the US companies now viewing CDMOs like Piramal? Do they see you as a smaller piece of the puzzle, or is there a shift in the strategic importance?
So overall, we've had actually 2 very good years. We've seen for this year overall, we've seen a 14% revenue growth on a consolidated level, and we've seen a 500 basis points improvement in our EBITDA margin. So over the last 2 years, we've seen a very good turnaround in our net profit from 190 crore loss in FY23 to a 90 crore profit in FY25, and we've reduced debt from 5.6 times EBITDA in FY23 to 2.7 times EBITDA this year. So overall, I think we've done what we said we would do, and we've seen a growth in a turnaround in the CDMO business. But I think going forward in this short term, there is macroeconomic uncertainty, whether it's biotech funding, uneven biotech funding that has not recovered over the last couple of years, and as well as with trade and tariffs and the pressure to onshore. So I do think there will be short-term and near-term uncertainty. In the medium to long term, actually, I'm very excited about the business. I do think that we as a company have one of the best networks. So for customers who want to make in the US, we have the capacity and the capabilities to make API in Riverview, sterile injectables in Lexington, as well as formulations in Sellersville. So we have that capacity available, as well as the capabilities and the experience. However, as I said, I do think there will be uncertainty in the next few months, which will take time to settle down.
All right. Hi, Nandini. This is Kanishka also joining in. I wanted to ask you, of the $180 million in FY25, that's your commercial revenue, a majority of it came from patent protected products. Now, you've indicated that FY26 could be a relatively muted year, due to low contribution from these specific products. So how do you see the numbers shaping up going forward in FY26?
I can't give you an exact number right now, but I do believe, as I said, we talked a little bit about the uncertainty, and we do believe there's a one-off inventory issue on behalf of our clients as they normalize in inventory. So as I said, I think next year will be a bit of a muted year on both growth and in revenue growth and EBITDA. However, we are expecting a return to growth is in PAT, in profit after tax, because we expect our tax rates to normalize a bit.
But Nandini, regarding the expansion of your injectable units in the US, is this being driven by the existing customer orders, or is it a strategic capacity build out in anticipation of future demand? When do you expect to see a pickup in the order flow to support this expansion?
So the first near-term expansion is for payload linkers in Riverview. That is part of our integrated ADC platform, which is a very exciting area at the moment. Now that we already have customers there and we were running out of capacity, so we're expanding and we should see pretty good utilization over the year. The Lexington one will actually open calendar year 27, so that's a little more longer term because it is a bigger expansion. We do have customers on site at the moment that will progress through the clinical pipeline. And as they were progressing, we realized that we didn't have the capacity were they to succeed. And so that's why we're actually building the expansion.
Okay, Nandini, let's also talk about the commercial product segment then that's been currently peaking. So what is the typical duration of contracts supporting them? Are these long-term multi-year contracts, or are they generally short-term in nature?
So these contracts are generally long-term in nature, but they're not always take or pay, right? But when you do the tech, it costs money and time to do the tech transfer, and when you actually perform with with the appropriate costs and appropriate quality, I think they tend to continue for a few years.
And lastly, Nandini, before we let you go, could you provide us a guidance for FY26 in numbers, both in terms of the revenue expectation as well as EBITDA margin guidance? What's the outlook for FY26?
I think what we've said is it will be a muted revenue growth as well as EBITDA for the next year, but we do expect an increase in PAT, especially as we think that the geographical kind of alignment will happen. So we think that there will be better growth across each of the sites, so our tax rates should become closer to normal.
All right. Thank you, Nandini, so much for joining us in this post-earnings chat and giving us all those insights. We'll connect with you later on the next earning as well.
If you like this video, then like, share and subscribe to ET Now.